the state of the rally and whether things have gotten a little too comfortable for investors. Well, let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, with me here at Post 9. Welcome back.
Thank you.
Are we too complacent? Has things gotten a little too easy? I mean, the VIX is now approaching 14 at least. It's not under 12.
Yeah.
What say you?
I think that we're getting close to that level where complacency is a risk, but we're not there yet. We can see in sentiment measures that you are stretched, but you're not extreme. Positioning measures, you're stretched, but you're not extreme. So it means that there's still probably some room for people to get pulled into this market, to get even more joyous into the end of the year. And then we'll have to judge it very closely in 2024 to see if those measures become a risk in and of themselves.
You think the market's in pretty good position for a pretty good year in 2024?
Well, I think a lot depends on the economic outcome. A lot depends on the path of things like liquidity. Liquidity was really powerful for valuation expansion this year. Valuations are up 20% for the S&P 500. They're up over 30% for NASDAQ and tech stocks. That's unlikely to repeat in 2024. So then we turn our eyes to earnings, and that's where the economic story comes in to say we have 11, 12% earnings growth in consensus right now. Can we deliver on that, or is there upside?
You think we can? Is that achievable? Is it a realistic number? It all comes down to that.
Yeah.
We're going to have to place our bets. Like, you're going to push your chips into the middle of the table long before we get the economy is just fine, or the Fed's going to start cutting, right? The market's going to place its bets ahead of that.
And I do think that the number of 11% is achievable. The upside to that really comes from two key wild cards. The first one would be productivity. Is there upside to margins from things like AI? That really remains to be seen. We'll watch it closely. And then it's from M&A and IPO activity, more capital market, capital deployment. The fact that the Fed could be easing rates could enliven animal spirits and allow for more activity in capital deployment as companies feel more confident. That could be that wild card of an upside driver. Then your downside wild cards are things like recession.
What about this broadening of the market? Do you believe that it can continue, and if so, why?
I do think that it can continue, but we want to make a big distinction between broadening of names that were quality but just left behind in 23 just because they weren't tech, and then names that are low quality that have been rallying lately on this idea of a Fed pivot and lower interest rates, that if you see the Fed not able to deliver on those interest rate cuts or interest rates move higher, those bad balance sheet names would be most at risk for reversals. So maybe they'll outperform over 3 months, but likely not outperform over more than that.
Can you differentiate those with more specificity for our viewers, like the kinds of stocks you're talking about?
Yeah, so what we do is we screen names based on quality factors like free cash flow generation, return on invested capital, as well as balance sheet leverage. So what you've had lately is that a lot of names with the most leverage on the balance sheets going up a lot. Take a name like Boeing. It's rallied 50% over the last 2 months. It's not to say that it's not has great drivers because of the global aerospace rebound. However, a lot of it's coming from the fact that it has $58 billion of debt on its balance sheet, and $18 billion of that having to be refinanced in the next 3 years. So how much of that is about the Fed, not necessarily the company?